Powell went ahead and enacted, as he said he would, a 75 basis point rate hike. I believe this is the fourth consecutive rate hike of that magnitude.
Yes.
They began in March with 25. They followed that with 50. And then all of the rest of the FOMC meetings this year had a 75 basis point rate hike. They're up now around between 3 and 3.5. And the key is this. Historically speaking, they want to get inflation to a target level of 2%. That, has never been accomplished without raising their benchmark rate to at least equal the level of inflation. So if inflation right now, the PCE has actually been running hotter since they started raising interest rates, but for them to effectively curtail and start to reduce inflation in a meaningful way, they're going to have the Fed funds rate anywhere between 4.5% to 6% before it really grips into the fabric of the economy that's telling people money's too expensive to borrow. We're going to have to start cutting things back. And that's the primary problem that we're facing. As we've talked about before, I believe it's because the Fed didn't act in 2021 when interest rates began at 1.4%, and by the middle of 2021 was already at 3 or 4%. Back then, 0.25% or 0.5% rate hike would have had a dramatic impact. They believed it was transitory. Because they got that wrong, it really tore up any of their long-term plans. If we look at what the Fed is facing now, they've let interest rates, by assuming that it was transitory and it would work itself out, to incredibly unrealistic numbers. We were as high as 9.5% in the CPI. The PCE core index actually rose in September when you compared it against not only August, but year over year, and it's well over 6%. The key is that to effectively reduce inflation, you have to have enough pain presented, meaning you have to have interest rates matching or close to that level. Now, when we compare this to the earlier days, we were looking at inflation, as you said, at 2.5%, 3%. Yeah. So what do you have to do to curtail it? Maybe raise your interest rates, your benchmark rates, to 1.5% or 2%. If we were dealing with 1.5% to 2% now, I guarantee that market participants would be focusing upon inflation sitting at 6% and not the tremendously huge raises and the magnitude of each hike in terms of interest rates. So they're apples and oranges in that prior they were working with a much smaller level of inflation and it was manageable to a large extent, whereas this scenario here is only manageable with some brutal actions by the Federal Reserve.
Okay.
The biggest part is something we haven't explored yet, and that is the absolute freight train we're calling dollar value. Of course, it's a misnomer because the dollar is fairly a weak currency, but when weighted against the basket of currencies that make up the dollar index, as I've said before, it's like looking in a basket of rotten apples and you pick out the least rotten apple, and that's the dollar. What's happening now is that yields are going up tremendously on 10-year notes, 30-year bonds. We've had yield inversions. And so when you have that occur, where the yields are raising, the yields are quickly moving to higher ground, what happens is you bring in genuine interest into the fixed income asset class, and then what happens is that pulls the dollar higher because you have a lot of foreign investments coming in, buying our bonds, buying our notes, and they're buying them up ferociously because even where, for example, Europe has got inflation at 10.7%, that was just announced, their yields are nowhere near what we're offering. So if you're an international investor looking to park money and you want it to be a safe haven play and you want to use a fixed income, you're going to go to our debt instruments and not at debt instruments of other countries. And it is that fact that's been giving us dollar strength. And of course, there's a negative correlation between the dollar and gold because gold is paired here with the dollar. Middle of 2011, gold hits the first of many record highs at $1,920. It then oscillated between $1,900 and $1,800 for a while. Then it broke down to oscillating between $1,800 and I think $1,564. I remember that number well because it stood there for 2 or 3 years, and then it methodically just started selling off until it hit just above $1,000. Now it's end of 2015, beginning of 2016. So now you've got inflation that is still mild compared to what we're looking at now, and you've got gold moving up. The focus was on the fact that it was easier to move gold up because inflation wasn't considered a tremendous problem that would wreak havoc on the economy. We're concerned now that the level of inflation the Fed is going to have to raise rates to will not only create a hard landing, but actually a recession. Now that's contrary to the last report we got last week of third quarter GDP, which actually showed robust growth, which I find is I'd like to look at those numbers deeper. But the point was there wasn't that genuine concern that inflation was going to run rampant and out of control back then. And so they could focus on gold. And plus, you didn't have the same dollar strength that you do now. The key, as far as I am concerned, is that when you consider that they're looking to move interest rates to say 5% minimum, they want to get inflation target to 2, so they're going to have to go to 5, maybe 5.5. That will devastate, if it already hasn't begun to totally erode the new housing market, rental incomes, the ability for first-time buyers to be positioned into a house, because as the way a mortgage works is they take all of your income, they take the current interest rate, divide it into a payment, and say you can spend up to 25% of your net income for your mortgage payment. Now, when that mortgage payment doubles because interest has gone from 2% to 6% or 5%, it really prices the majority of people out of homes, and those that aren't priced out are priced out of the homes they wanted. So you get a huge contraction in the housing market. And that contraction, because it's such a big component of our overall industry and growth in North America and Canada, as well as the United States, that it is going to truly be detrimental on having economic prosperity. You can't have it when people can't buy a new home or even rent a home. You can't have the kind of prosperity that we have grown so accustomed to. As far as the Fed goes, they have mortgage-backed securities and they have U.S. debt instruments, notes, and bonds. They have to go and refinance them when they mature, and they have to refinance them at a higher rate.
Yes.
So it's a big impact. It's a tremendous impact. The article I read said that they were losing billions upon billions each month, and that was the Federal Reserve. Of course, Yellen has been very vocal about, look, we got to get something together because I'm not going to be able to pay these bills. And she's very prudently fiscal about doing these things. So she realizes that there's problems down the road there too.
Why are the odds so stacked against the Fed this time around?
Because they didn't act in 2021 when interest rates were at 2%. They waited until they went to 9.5%, 8%, before they even raised rates by a quarter basis point. It's ridiculous. Had they acted a year earlier, listen, things were returning to normal in 2020. There were still supply chain bottlenecks. Many people were working from home. The employment numbers were still great, but things were slowly pivoting to a new normal, whatever that new normal is, and I still don't have an answer for that. but they did nothing. And they did nothing because A, they assumed it would naturally work itself out, and B, they believed that there was nothing they could do to really dramatically affect it. I believe at some point in time, and I have no timeline for this, and I have no idea of how much pain will be between now and then to get there, but at some point we will have regulated inflation to a new target. I don't think you'll ever see 2% for a while, but maybe 3.5%, which is going to be real acceptable when you're coming from 9, okay? And at the point that happens, market participants will finally be able to shift their focus from higher interest rates to the value of gold as it's compared to other currencies that are fiat currencies. And that's when we could see gold take off. And at that point, I would not be surprised over the next 2 years to see it challenge 2,000 to 2,200. That's a longer term window that I'm looking at. But there's so many ifs involved in what needs to take place in order for gold to actually gain substantial value, and there's no way to put a time parameter on that.